My guest today is Mike Scanlon of BornToSell.com, and we're talking about covered calls, but specifically which stocks in your portfolio you should be writing calls against. So Mike, if I've got a basket of say 20, 30, or 40 stocks, which ones should I be selecting for covered calls?
You can write covered calls against almost any stock. They have options available on all stocks traded these days. The ones you want to write against are probably ones that may not have earnings coming out right away, because the volatility, although it drives the option premium, will limit your upside with the covered call strategy. If it's something you're bullish on, you probably don't want to cap your upside. Other stocks, that are low beta, that are not as volatile, you may still find it's worthwhile to write calls against, but you have to go out 3 or 6 months. The short-term 1 month options probably don't have enough premium in them.
All right, and if I've got 100 shares or 1,000 shares, should I be writing covered calls to equal exactly the number of shares I have of the underlying?
Right, well there's a 100-to-1 ratio between the option contract and the shares. So if you have 100 shares, you'd write one contract. If you have less than 100 shares, you can't write a covered call. And it comes down to transaction costs. If you have a single contract trade, you may find the transaction cost is a bigger percentage of the premium than you're happy with. So you may need 200 or 300 shares or more to make it effective.
Okay, and then if I'm writing against half of my portfolio, is there anything I can do with the other half to make money with options? Can I sell a put or something if I want to buy more of those things?
Sure. Well, selling a naked put is the same trade as a covered call, so you could do that. It's a good way to acquire stock at below the current price. I would write calls against everything you have. There's really no reason not to, considering transaction costs, of course.
All right, how about spreads? We get into more complicated iron condors and things like that. How about those kinds of strategies?
Those are worthwhile strategies, and people do well. They require a little more maintenance because they are multi-legged spreads, and it's not as easy to modify those positions once you're into them because you have multiple legs and they each have a separate bid-ask spread. So there's a little more slippage when you roll those positions to another one. Conceptually, covered calls are very easy. A lot of people get them. It's a two-legged trade. You own the stock, you short the call. Very simple to get, and anybody can do it to own stock.
I've noticed over the years, and especially in the last 5 years, the investor sophistication with calls and strategies and options in general has really accelerated. What do you attribute that to?
Options popularity has been increasing like crazy. The number of options traded is going up 25% a year for like the last 39 years, and now they have the weeklies trading on 160 different stocks. I think people are just getting better educated about it. They're tuned into the strategy. They realize it's a low yield environment, and selling calls against their stocks, they can get more yield from things they already own.
All right, and you mentioned the weeklies. What about using weeklies as covered calls?
It's a great strategy, because the sum of a 4 weeklies time premium is going to be larger than a 1 month time premium. So selling the near-term option is always a way to get the most time premium out of your equities.
But transaction costs, as you mentioned, may go up as well.
That's right. Yeah,
okay.
Definitely.
All right, are there certain sectors in my portfolio that are right now are particularly good for covered calls? Is it just the most volatile, whatever that may be?
Well, the call premium tracks the volatility, so the volatile ones pay better. You really shouldn't buy stock to write calls against it unless you fundamentally own the stock. So my first rule is buy stock you're happy owning anyways, as even if you weren't writing calls against it, and then write calls against it to get some extra yield off of it. But I wouldn't recommend buying stock specifically for the purpose of writing calls just because it has attractive premiums. You're going to get into some really risky situations, and you may not take the time to do the homework and find out why are those premiums so high. Maybe there's an FDA announcement, an M&A rumor circulating, and if you don't have the reason why those premiums are so high, you can wake up one morning in a bad situation.
All right, and then finally, do I let them go to expiration if they're in my favor, or should I be safer, lock it in if I'm close and I've made a profit here, and then wait till the new cycle begins and buy them again?
Yeah, it depends on how close the stock is to the strike price. If it's real out of the money, I just let it expire worthless and save the transaction cost. If it's in the money and you want to roll it, it's probably a good idea to roll it before expiration so you don't subject yourself to early exercise. But if you've got 80-90% of the premium out of the position you thought you were going to get, it's reasonable to close it out at that time.
Mike, thanks for your time.
Thanks, Tim.
You're watching the MoneyShow.com video network.